Theoretical framework of behavioral finance is a study based on the concept of behavioral finance. We all know behavioral finance is a concept based on the psychology of individuals, the role of psychology in our financial decision making activities, the role of our beliefs, ethics, customs, traditions, etc. in our consumption, investment, savings, and spending activities. So, behavioral finance ultimately deals with the impact of psychology in our financial decision making activities. So, this study focuses on the theoretical aspects of behavioral finance. Theoretical framework of behavioral finance is a conceptual paper which describes various theoretical aspects related to the behavioral finance concept. The ultimate purpose of the study is to identify and understand various behavioral finance theories, behavioral biases, and various contributors in the evolution of behavioral finance. We all know traditional finance is based on the assumption that investors are rational and the markets are efficient. But in actual practice, these two assumptions of traditional finance are found to be unrealistic. So the concept of behavioral finance has got a greater significance and wider scope. So the concept of behavioral finance focuses on the impact of psychological factors in decision making, so that investors do not always behave in a rational, predictable, and an unbiased manner. So according to behavioral finance, investors are not rational and predictable, and they are behaving in unbiased manner. Behavior finance studies the psychological factors that influence the financial decision making process of individual groups and entities. And ultimate purpose of behavioral finance is to understand why people make certain financial choices and how those choices can affect markets. So the major objectives and methodology of the study. Major objective of the study is to describe various theories of behavioral finance, certain behavioral biases, and various contributors of behavioral finance. Then the study is descriptive in nature and is based on secondary data, and it is collected through journals, articles, books, newspapers, websites, and internet, and so on. So the study is entirely based on secondary data. It was collected through journals, articles, books, newspapers, websites, internet, and so on. Then the major aspect of the study, that is the various theories, biases, etc. Then the prospect and regret theories. Prospect theory states that the people always value gains and losses differently and will take decisions on the basis of perceived gains rather than perceived losses. So in a financial context, people should take decisions, and most of the decisions are based on the value of their perceived gains and losses, and people should give more importance to the perceived value of gains when compared to the perceived value of losses. That is the base of prospect theory. So if a person were given two equal choices, one expressed in terms of possible gains and other in terms of possible losses, most of the people will choose the choice in terms of gains. So according to prospective theory, there are two stages in decision making. First one is concerned with the editing stage. It includes the framing of all choices according to potential gains or losses. And the next stage is the evaluation stage, that is concerned with the choosing an alternative. So that is all about the prospective theory according to the study. Then regret theory. Regret theory explains various errors happened in judgment because of emotional reactions. Due to our emotional reactions in financial activities, certain judgment errors were happened. Then the theory of regret aversion proposes that when facing a problem, individuals might expect a regret and thus take choices to eliminate or reduce this probability. So for every decision there is a possibility of loss, and so the people should always try to eliminate or reduce the probability of regret or expectation of regression. So the example is that investors hold stocks that have gone down in order to avoid the regret of having made a bad investment. Then certain contributors towards the concept of behavioral finance are Daniel Kahneman, Richard Taylor, Robert Schiller, Vernon Smith, Herbert Simon, Main Statman, Tversky, Anders Scheffer, etc. are the major contributors. Among them, Daniel Kahneman, Robert Schiller, and Richard Taylor. These are the major contributors behind the concept of behavioral finance. Then some of the theories, historical theories formed as a part of behavioral finance concept are explained. Model of bounded rationality, it is an important one developed by Herbert Simon. Then theory of cognitive dissonance found by Festinger. Then the heuristic biases. Daniel Kahneman is the major propounder. Then the prospective theory, Daniel Kahneman and Tversky. Then the important one is the mental accounting bias. It was founded by Richard Taylor, and a number of contributors were worked behind the concept of behavioral finance, including Meir Statman, Andreas Schleifer, Barbes and Taylor, etc. Meir Statman, etc. are the major contributors behind the concept. Then what are the behavioral biases in investing? Certain biases mean certain kinds of illogical decisions in activities. The first one is mental accounting. It is a tendency to segment or classify our money according to the source from which it is obtained. Or people should classify their money into mental accounts based on the variety of subjective criteria like source of money and intent for each account. So people should classify their income according to the source from which it is obtained and for what purpose it is used. It includes psychological classification of needs, mental budgeting, fund allocation, over and underspending, satisfaction of needs, etc. Examples are tax refund, birthday money, bonuses, lottery winnings, then confusing identical purchases, etc. are major examples of mental accounting. Then what is herd behavior? Herd behavior means we all know herd behavior is the tendency to imitate the financial opinion of majority. Considering in case of new investors or lack of experienced persons, they should imitate the activities of others. The major reasons of herd behavior are fear and inexperience, emotions, greed, imitation of majority, etc. Examples are fan base of celebrities, development of trends, majority of investors purchase a particular share, etc. Then certain other biases are anchoring bias. Anchoring is a mental shortcut, and it is a heuristic revealed by behavioral finance that it describes the use of subconscious use of relevant information, such as the purchase price of security according to a fixed reference point. Then loss aversion. It is a bias towards avoiding losses or seeking gains. We all know people are more sensitive to losses than they are to be comparable gains when making decisions. Then overconfidence. It is the problem with the overconfidence bias is that it can make an investor overestimate their abilities and knowledge, which can lead to rash or poor decisions. This is the overestimation of their abilities and skills. Then the conclusion of the study is that behavioral finance is popular and familiar now, and a lot of researches were conducted in the area, and a large number of theories are discovered. Major contributors are Daniel Kahneman, Richard Taylor, Vernon Smith, Robert Schiller, etc. are the major contributors. The concept of behavioral finance is emerged by questioning the practicability of traditional finance concepts and assumptions. So this paper summarizes various theories of behavioral finance, propounds behavioral biases, history and emergence of behavioral finance, and various contributors. Moreover, a large number of research studies are still conducting in this area. So it is expected that certain new theories and concepts will be developed in the coming years.